On a recent video I published, building a high dividend portfolio using ETFs, I got a request to do an analysis of Terraform Power. At the time, it was because they seemed undervalued and they have a high dividend yield north of 7%. So, in this video, I'm going to go through the analysis that I did and to see if their 7+% dividend yield is reliable and are they truly undervalued. Hey YouTube, I'm Jimmy. If this is your first time to my channel, well, what we do here is we talk investing. We cover everything from the basics of investing to individual company analysis. We look at recent stock market events. We build portfolios. And ultimately, what we try to do is we try to get your money to work harder for you. So, if investing is something you do or something that you want to do, then hit the subscribe button and don't forget to hit the bell notification so you can get updates when we issue new videos. So, Terraform Power. Their ticker symbol is TERP. They're an interesting company, and they describe themselves as a renewable power company that seeks to provide an attractive and sustainable total return to investors. So basically, what they do is they focus on solar energy and wind energy. Okay, let's have a closer look. So Terraform has a bunch of locations, mostly in the United States and some in Europe and a few in South America. I pulled on this map from the recent presentation, and the orange icons are solar panels, and the green ones are wind farms. This is a map of the United States, and then this map is what they do internationally. They're mostly located in Spain and Portugal. So before we look at the numbers, I want to take a moment and first introduce what I found as far as their corporate structure is concerned. It's not the simplest corporate structure I've ever seen. I guess it works from what they're trying to do and how they're all set up, but here, let's go through it. So this one up here, this is Terraform Power. This is us. We're the investors. Now, just to be clear, I don't own any shares of Terraform right now, but if I did, or if you did, then this is where you would be. Well, investors can buy Class A common shares, but only up to 35% of those shares, because the remaining 65% is owned by a company called Orion US Holdings. And Orion US Holdings is controlled by Brookfield Asset Management. They're public as well. Their ticker symbol is BAM. By definition, this makes Terraform a controlled company. Now, being a controlled company is not necessarily a good or a bad thing. It's just worth noting. See, one of the advantages of public companies is that as a shareholder, you get to, when you buy those shares, you get to vote on who's on the board of directors, and they get to vote on who the CEO is and who management is. Well, when you buy into a controlled company, they control the vote, therefore you're sort of giving up your right to really control the destiny of the company. And in this case, Brookfield, well, they call all the shots here. Well, this is not bad since Brookfield has a ton of experience doing this exact type of thing with other similar companies. Okay, so continuing down the hierarchy. So below Terraform, the public company, well, Terraform Power Incorporated controls Terraform Power LLC. Terraform Power LLC controls Terraform Power Operating LLC. And they own the individual companies that actually do the work, like managing the wind or solar panels. Now, one important point to note is that there are debts tied to some of these different entities. Now, the good part about accounting rules is that since these companies are all tied together, they have to report what they call consolidated financials. Basically, that just means that everything that each of these companies control are all tied into one company's financials. So, on their last quarterly filing, TERP reported $3.4 billion in long-term debt. Now, some of that debt is what they call non-recourse debt. Non-recourse debt is debt that is secured by collateral, in this case, the solar panels or the wind farm or whatever it might be. The non-recourse part means that whoever they loaned that money to, the lender can come and take that collateral, so perhaps the wind farm that's tied to that loan, but they can't take anything more. They only have access to the asset that is specifically tied to their loan. Now, I bring up the debt because I think that this seems like a lot of debt for a company that only had $610 million in revenue during 2017. And that actually brings us to a different recent event. So first, the ownership stake that Brookfield has of Terraform. In Terraform's most recent presentation, it's listed as Brookfield's stake as being 51% and 49% are to the public. Well, when I was reading through some of the recent news, I came across that Brookfield recently upped their stake from 51% to the 65% I mentioned before. Now, what this did for Terraform, what Terraform got out of it, is Brookfield paid them $650 million to help purchase a recently announced acquisition of a solar and wind portfolio of SATA. Now, that's based out of Europe, and the maps that I showed you before that had all the different solar panels, mostly in Europe, that includes the SATA acquisition. Now, it's important to point out that Brookfield paid $10.65 per share to get to that $650 million that they gave Terraform. So this deal's a big one for Terraform. Now, regulatory-wise, it's already been approved, and we have no reason to believe that it won't go through. So, with that being said, I think that we can go ahead and assume it's going to be and see what we can do as far as coming up with a valuation. So here are their financials going back a few years and projecting a few years according to consensus estimates. Now, I think for us, the important point here is that they're not profitable just yet, although they have very recently started paying a dividend. So without profits, it's difficult to use something like a PE multiple since they have no earnings, and discounted cash flow is tricky since their cash flow is somewhat unreliable at this point. Now, since dividends are a major part of what they're doing and what they're projecting to do, I think that it's fair for us to try to use something like the dividend discount model. Now, at some point I'll make a video on just the dividend discount model, but for the sake of this video, roughly speaking, what we do with the dividend discount model is we project dividends out, then we assign a growth rate to it, and then we discount what those projected dividends would be worth today. So, to support our use of the dividend discount model, management actually gives us a potential growth rate of dividends. So, what we did is we took the middle number there, we took 6.5%, and we used that as the growth rate. So now what we have to do is we have to discount that all of the future dividends back to today. Now, to properly apply the dividend discount model, what you're supposed to use is the investor's required rate of return. For me, and for this situation, I'm going to use WACC, which is weighted average cost of capital. And after I calculated WACC, I came up with slightly less than 8%. Now, when I calculated fair value based on a 6.5% growth rate and a required rate of return of 8%, I got a fair value of $12.50. Now, the dividend discount model, like many models where you discount future cash flow or dividends or revenues or whatever it might be back to today, is very sensitive based on the inputs you use. Had I used a 10% required of return instead of an 8% one, I would have gotten a fair value of $10. If I had used a 6% required rate of return, then I would have gotten a fair value of almost $17. And I bring this up because I believe it's important to keep in mind that we don't just blindly accept this fair value as being a factual number. Yes, it is factual that $12.50 is the value based on the inputs and based on what we expected dividends to be, and I just used consensus estimates for that. But the inputs outside of consensus estimates are just my opinion, so I think that's for what it's worth. So, all this being said, what's the conclusion? Well, to me, I actually think that this is a very interesting company, and I would never make it a huge part of my portfolio since I believe that they're at the very early stages of executing their business plan. But they have started to pay dividends, and that is going to be a large part of what I believe will be their total return going forward. And we can see that they have a great dividend yield. It's a bit over 7%, and actually it's a bit over 7.5% right now based on the current price. Right before I started filming this, it was about $9.90 when I started filming. Plus, I actually like what Brookfield brings to the table. They have a huge portfolio of companies just like this one, and I expect for them to execute on their plan with Terraform like they have with many of the other businesses. Plus, they own a huge piece of this business, 65% to 35% of the public market. So they have an interest in this doing well, and in theory, that share price rising and that dividend rising. Now, from a risk perspective, it's important to realize that companies like Terraform that are mostly trying to grow from acquisition And one thing that Terraform does is when they buy an asset, a solar farm or a wind farm, they want that asset to already have a contract in place, and then their job is to execute it. But they have to acquire those assets. And in order to do that, they usually have to either issue more debt, which in theory weakens their balance sheet and increase their interest expense, or, and I think this is more likely to happen, they have to issue more shares, like they recently did to get the $650 million from Brookfield. And if they do that, the real question is that acquisition accretive? Basically, what accretive means is that it will add more to earnings per share than it hurts me for my piece of the pie being smaller. So, in conclusion, I like Terraform. I think it's a good, solid, little company at the early stages of growth potential. They've got a great yield. So, from a yield side for my portfolio, that adds some cash that I can use in other places. But they don't quite have the revenues and profits or dividend coverage that make me confident that that dividend is really sustainable. I do expect them to grow with the help of Brookfield, and since Brookfield has lots of experience here, I believe that they can execute on that. But it would take them actually executing on it and profits and proper dividend coverage for me to move this to a full position. How about you? Do you like the company? Do you think that there are any better companies out there that you would rather me review, or perhaps something that you have in your portfolio that you think is awesome? So, if you have any companies that you want me to review, post in the comments below. Or if you have any thoughts or ideas or anything that has to do with investing, post it. And if you made it this far in the video, I really do appreciate it. And if you haven't done so yet, hit the subscribe button. Hit the bell so you can get notifications when our next video comes out. And that's all I got for now. So, I'll see you in the next video.